Hey guys, we're going to talk about NIO. A few questions raised today were around NIO and a huge trade that transpired in the 50 strike. You can see what the stock has done. Back at the beginning of the year, it was trading at $1 to $2. We actually had a huge spike up with implied volatility, hit $16 and then came all the way back down to almost 10. They reported a profit back in August. And everybody went, what? How did they make a profit? And then this thing is just taken off, and then they have earnings on November 17th. So this is kind of crazy move. But someone said they saw something in there. And they said, yo, uncle, take a look. The 50 puts, 4,000 contracts traded at the 50 strike. Look at the stock, it's at 41. And they said, wow, somebody is selling puts. And if someone were selling puts, that would be the same strategy as buying stock and selling a call. And look at the calls. Now the calls have also got 2,500 contracts. So this is starting to look like some kind of risk reversal. But we can't be sure. I can show you in the time and sales. What can we see in time and sales? I did it by just the 50 put. And there's not that many trades. And so we can see, if we look at the time frame, there are two batches of trades that were done at 12:13 and at 2:18. So those are the puts. But what about the calls? Now we can change our filter criteria in here and say, don't show me the puts, show me the calls. Now, if we go through the calls, there's a lot more individual trades in here. But look, here's one right here. The time looks similar. And we keep looking through here to see if there's anything else. And here's another batch. The time is the same as the puts. Now let me show you a trick. If you see puts and calls, or if you see a few different strikes and you're thinking they've been done as some kind of a spread or some kind of a trade, include all of them in your filter. So I'm going to put both puts and calls. Now when we go back and look at 2:18, what do we see? Now we see two sets. We see puts and we see calls. And we'll see the same now at 12:18. What do we see? Or 12:13. Aha! You see what happens when you combine the strikes together? Now we can see everything that happened at the exact same second. Both the puts and the calls were all done at the same time. Now by looking at the bid and ask price, we can try to guess whether they're buying them or selling them. All right. Now I put these onto a spreadsheet. Let's go take a look. This is interesting. This is for NIO, and I've combined the calls on the left and the puts on the right. These are the two time frames when they came out. What we see is 1,000 calls and 2,000 puts, and then the same thing 2 hours later. So although you see a bunch of little trades, they add up to 1,000 and they add up to 2,000. That's how they try to split the orders up, so it's not so obvious that it's a big order. They're trying to sneak around and split them up. We're too smart for these guys. We can find them. They can't hide from us. So what we see is a total of 2,000 calls, okay, and then 4,000 puts. Now, based upon the bid and ask when the trades were done and how the implied volatilities changed, my best guess is that they sold the calls and bought the puts. Now, let's do some analysis and see what this means over time. What do these calls and these puts look like from a P&L perspective? Let's jump over to the Analyze page. Now we're in the Analyze tab of Thinkorswim. And here I've gone down below and I've sold 2,000 of those calls at the average price of $17.60 and bought 4,000 of those puts at $25.20. Those are the average prices that he was able to get on his trade. So I'm sure this guy's going to be pulling his hair out if he sees this video. He's going to be, holy crap, I split my order up, sent it on 5 different exchanges. How in the heck did this guy find me? Yeah, well, that's what happens. So here is what this means. This trade requires $6 million in margin. Okay, so this is not a retail investor. $6 million in margin required to put this trade on. Now, what does this trade mean? What it means is that if he sold the calls and bought the puts, what that means is his break even in January 23 is actually $33.65. If the stock goes back down to 20, okay, he is going to make $5.4 million if it goes back down to 20. And if it goes back down to 10, well, actually, if it goes all the way back down to about $8.50 per share, if it goes back to $8.50, he'll make $10 million. Okay, $10 million. Now, this is what we call a risk reversal. Why do we call it a risk reversal? Is because normally the person who puts this trade on owns the shares. What kind of owner would put a risk reversal on? That is possibly an insider. That could be the CEO of the company, or it could be a big fund manager, but it's someone who owns shares and they want to lock in their profit. They don't want to lose money on this stock. So it's someone who's got a big position in all likelihood, and they're locking in their profits. It's called a risk reversal. If the stock plunges from 50 back down, basically this person is saying, hey, I've got to keep my shares because they're locked up. How can I lock in my profit? And they basically told the person, and goes, I can get you a deal where if the stock drops below 33.51, you won't lose anything. You won't lose any money below 33.51. And that person said, oh, we're going to go a lot lower than 33.51. And so what that means is they're thinking that the stock is likely to drop back down, or they're thinking, hey, I'm up $100 million, and 2 years from now, if I know I get to keep that $100 million, I'm very happy to pay however much money is required, $6 million in margin, to allow me to lock in a $100 million profit down the road. Now, we're looking at how many puts? We're looking at 4,000 puts, which is the equivalent of 4 million shares. And he's only sold 2,000 calls. But if we assume he's got 4 million shares, then buying 4 million puts, it will protect him down at 33.50. Right? If it gets back down to 8, he's going to make $10 million profit. So that's the strategy. This is what I think is happening in there. So that's kind of interesting. Yes, so my guess is someone is trying to lock in profits before the earnings report in a week's time. And they're either just up a lot of money and want to lock it in, or they know things aren't going to be good going forward. They're not as bullish as the market, and they want to find a way to not lose if the stock drops. So leave any questions or comments down below. But that was kind of interesting little forensic science we just did there. So good luck. If you see some other interesting trades, let me know. I'd like to take a look at them as well. Cheers.